The Roth IRA was designed to be a safety net for the middle class, a boring, limited account where you park a few $1,000s a year. But in 2021, a leak revealed that Peter Thiel's Roth IRA didn't hold a nest egg, it held $5 billion. And here is the kicker: the IRS cannot touch a single cent of it. How do you stuff $5 billion into an account with a $2,000 annual limit? You don't get there by saving. You get there by engineering a financial anomaly. While everyone else was buying mutual funds, Thiel executed a specific maneuver in 1999 known as asset location. He didn't break the law. He inverted the math, buying founder shares for a fraction of a penny. Today, we reverse engineer the exact trade that turned $1,700 into a tax-free empire. Welcome to Capital Logic. To understand the mechanics of this trade, we have to transport ourselves back to early 1999. PayPal did not exist yet. The company was called Confinity, and at this stage, equity is not money. It is a lottery ticket with a 99% chance of expiring worthless. Most founders make a fatal error here. They buy their founder shares in their own name. They pay a nominal amount, and if the company succeeds, they face a massive capital gains tax on the exit. Thiel was playing a different game. He looked at the Roth IRA and saw a vehicle with a notorious flaw: the contribution limit. In 1999, you could strictly only contribute $2,000 per year. For a Wall Street banker, this limit makes the account useless for building massive wealth. You cannot buy enough IBM stock with $2,000 to move the needle. But Thiel didn't look at the $2,000 limit as a cap on value. He saw it as a cap on cost basis. This is the critical distinction. He realized that if he could acquire a massive volume of shares for a nominal price, he could squeeze a significant percentage of the company into that tiny $2,000 box. Here's the execution. Thiel issued himself 1.7 million shares of Confinity, but the key variable was the strike price. He valued the shares at 1/10 of a penny, $0.001 per share. At this valuation, the total purchase price for 1.7 million shares was exactly $1,700. Because $1,700 is below the federal limit, the transaction was perfectly legal. He wrote a check from his Roth IRA, and the shares were deposited into the tax-shielded account. How did he get away with valuing a future billion-dollar company at a fraction of a penny? This is valuation arbitrage. In 1999, Confinity had no revenue and highly speculative technology. In the eyes of the IRS, those shares were technically worthless. Thiel used the high risk of failure as a shield to lock in a rock-bottom price, smuggling the equity into the tax shelter before the market realized what it was worth. 3 years later, the lottery ticket printed. By 2002, PayPal had revolutionized online payments, and eBay, realizing they could not crush this competitor, bought them for $1.5 billion. For the average early employee, a liquidity event of this magnitude is a moment of jubilation, followed immediately by a sobering reality check called the Internal Revenue Service. When you sell shares in a standard brokerage account, you trigger a massive taxable event. On a windfall of millions, you are immediately cutting a check to the Treasury for 20%, plus state taxes. In California, that effectively erodes a third of your hard-earned wealth overnight. But let's look at Peter Thiel's account. The 1.7 million shares he bought for $1,700 were now worth millions. In a normal world, this is where tax drag destroys the compounding effect. But because these shares lived inside the Roth IRA wrapper, the rules of financial physics changed. The Roth IRA is a post-tax vehicle. You pay taxes on the money before it goes in, but you never pay taxes on the growth inside. When the eBay wire hit, the cash didn't land in Peter Thiel's personal bank account, it landed in the Roth. The capital gains tax was not reduced, it was eliminated. Zero. The government saw a transaction that turned pocket change into a fortune, and legally they could not demand a single cent. This is the pivotal moment that separates the rich from the dynastic. Most founders get rich, then hire accountants to mitigate the damage. Thiel inverted the timeline. He built the fortress before there was anything to protect. By the time PayPal was sold, the structure was already hardened. The capital was now born inside the shelter, meaning every future dollar that capital earned would also inherit the tax-free status. The snowball had begun to roll, and there was no friction to slow it down. Now, having tens of millions of dollars sitting in a retirement account usually signals the end of the game. Conventional wisdom is to park that capital in low-risk index funds and wait for your 65th birthday. But for a strategic operator, cash is not a safety net. It is ammunition, and Thiel possessed the most efficient ammunition in the history of finance because it was unencumbered by what economists call tax drag. Tax drag is the friction that slows down wealth accumulation. Every time you sell a winning asset to move into a new opportunity, the government takes a slice, leaving you with less capital to invest in the next deal. Over 30 years, this friction can reduce your final net worth by 50% or more. But inside Thiel's Roth, the friction was zero. He could rotate capital from one high-growth vehicle to another with 100% efficiency. In the summer of 2004, Thiel met a young Harvard dropout named Mark Zuckerberg. At the time, Facebook was a chaotic project run out of a dorm room. It was risky, unproven, and exactly the kind of asymmetric bet Thiel looks for. He agreed to become the first outside investor in Facebook, putting up $500,000 for a 10% stake in the company. Crucially, he did not write this check from his personal checking account. He wired the funds directly from the Roth IRA. Think about the leverage here. He used tax-free profits from the PayPal exit to fund the seed round of the next tech giant. When Facebook went public in 2012, that $500,000 stake had ballooned into hundreds of millions of dollars. In a standard account, closing that position would have triggered a federal and state tax bill in the 9 figures. It would have been the largest tax bill of his life. Instead, the proceeds washed back into the Roth IRA, completely untouched. This created a flywheel effect that is almost impossible to replicate in the public markets. He took the PayPal winnings, rolled them tax-free into Facebook, rolled the Facebook winnings tax-free into Palantir, and continued this cycle for 2 decades. It wasn't just one lucky trade, it was a sequence of compounding events where the house never took a cut. This is how the account breached the $5 billion mark. It wasn't magic, it was simply the math of compound interest allowed to run wild without the interruption of the taxman. Naturally, when a government agency sees a retirement account larger than the GDP of a small island nation, they start asking questions. The mechanism Thiel used sits on a razor's edge of legality, specifically regarding a set of IRS rules known as prohibited transactions. The tax code is explicitly designed to prevent self-dealing. You cannot use your IRA to buy a vacation home that you personally live in, and crucially, you generally cannot invest retirement funds into a business where you have a controlling interest. The logic here is simple. The IRS does not want you manipulating asset prices between your personal wallet and your tax-free wallet. If you own 100% of a company and you sell shares to your IRA for a penny when you know they are worth $1, that is considered fraud. So, how did Thiel survive the scrutiny? The answer lies in the specific architecture of the cap table. At the exact moment the transaction was executed in 1999, Thiel did not legally own more than 50% of the combined voting power or total value of Confinity. He had co-founders like Max Levchin, he had early investors, He carefully structured the equity split to ensure he remained below the strict percentage threshold that defines a disqualified person in the context of an IRA transaction. This wasn't just a theoretical defense. In 2012, the IRS launched a massive audit of Thiel's finances. They were looking for a crack in the armor, a mispriced asset, a violation of the ownership percentage, or evidence that the shares were not an arm's-length transaction. They dug through the valuation methodology of 1999, looking for proof that the shares were worth more than 1/10 of a penny. They found nothing. The audit concluded with no charges of wrongdoing. The strategy was aggressively engineered, and it certainly violated the spirit of what a retirement account is supposed to be, but it adhered strictly to the letter of the law. This highlights the most uncomfortable truth of the American tax system. It is not a system based on fairness, it is a system based on code. Thiel didn't cheat the system, he read the instruction manual better than the authors did. The account remained intact, and the billions remained tax-free. The story of Peter Thiel's $5 billion retirement fund is not really about PayPal, Facebook, or the tech industry at all. It is a masterclass in a financial concept called asset location. Most investors spend their entire lives obsessing over asset allocation. They worry about which stocks to pick, which sectors to buy, or how to time the market. They focus entirely on the offense, how to generate returns, but they completely ignore the defense, how to preserve the capital. Thiel realized early on that the single largest expense in a lifetime of investing, it is taxation. The logic he applied is ruthless but replicable in principle. He identified the asset with the highest potential for asymmetric growth, his founder stock, and he placed it in the only vehicle that could shield it from the government. He understood that placing a safe, low-yield bond in a Roth IRA is a waste of valuable real estate. The Roth is designed for moonshots. If you take a 100x bet in a standard brokerage account, you're effectively entering a partnership where the government takes a third of the upside, but none of the downside risk. By placing that bet inside the Roth, Thiel privatized the gains entirely. You can't replicate the penny stock valuation of 1999 today. The IRS has tightened those specific loopholes. But the underlying principle of asset location remains the most underutilized strategy in wealth creation. Wealth is not just a function of what you earn, it's a function of your efficiency. Peter Thiel proved that a simple administrative decision, signing the right paper at the right time, can be worth more than the business itself. It's the difference between being rich and being a dynasty. If you want to move beyond generic financial advice and understand the hidden mechanics that actually drive the global economy, you're in the right place. We don't do motivation here, we do analysis. If this breakdown added value to your understanding of wealth, like this video and subscribe to the channel. Leave a comment below. Do you think the Roth loophole should be closed, or is it fair game? We want to hear your take. Share this with a friend who needs to see the blueprint. Welcome to Capital Logic.